Hello, everyone. Welcome back to another Lunch and Learn webinar series. This is Mayur Thaker speaking. I'm one of the senior relationship managers here at Zacks, and I dedicate myself, full time to, to providing service as well as training to all ZRS clients and Zacks clients in general. So hopefully this is another webinar of help and a nice little guide through these difficult times that we're all looking at and facing right now. So, and that's really what prompted this specific webinar, where we're going to be focusing on screening for quality using the Zacks Advisor Tools web-based portal. And right now, when everything is basically trading on these macro headlines that we get every day, it's difficult for an advisor to, really be able to cut through, a lot of the noise that we see and hear every day, like today with the Fed and their new announcement of additional quantitative easing. What can we do as advisors, and how can we communicate to clients very clearly as to what, portfolios you're building for them and why? So we're going to focus on that a little bit here today. And the basis of this entire presentation was really prompted by a paper that I came across in the Financial Analyst Journal. This is the flagship publication by the CFA Institute. And there's an article, the title of it is simply, "What is Quality?" It was published last year, and the paper really delved into the key factors of quality, and what do we mean by that? And what they found is that whether you're a growth manager or a value manager, or even a GARP manager where you like to look at both growth and value, there is one factor that needs to be incorporated, or really ought to be incorporated, into whatever strategy that you follow, whether it's a dividend-oriented approach, whether it is a value-oriented approach, whether it is growth-oriented, whether it is any other style that you are following, in terms of building portfolios for clients. Quality should be at the forefront of that. It's sort of like the handle to your coffee mug, where no matter what you put in the cup, it really needs to be on a solid foundation. And so these authors wrote a paper and found that, profitability ratios, earning stability, capital structure, profit growth, accounting quality, as well as investment are all factors of quality that really add value to whatever investment discipline that you follow. And of those, these factors really added value. So I highlighted those in green here. Profitability, including return on equity and return on assets. Accounting quality, which measures cash flow and free cash flow versus earnings, as well as investment. And what do we mean by investment? That's simply how companies are choosing to invest their money in growth projects, as well as other projects like R&D. So we're going to use advisor tools to be able to very, very quickly and easily screen for companies that have these very favorable quality characteristics. And the great thing about Zacks Advisor Tools is that we have basically distilled this entire paper into very simple, very easy to use, screening ratios. So I'm going to jump right into the Advisor Tools page. So this is my Advisor Tools. I'm in the screening section right here. So if you click on the screening or hover over the screening tab and go over the equity screener, this is our brand new equity screener that we just launched recently, and we had a webinar on this just about a week ago. And if you missed it, no worries. What we're going to do here is start to incorporate some of these characteristics that we just saw listed here into our screening criteria. Now, these are a lot of balance sheet and income statement and cash flow statement ratios that requires diving into those financial statements and doing a number of complex calculations. The good news is we've got all of that sort of pre-calculated and ready to go right within the screener itself. So once you go over here, this is what you're going to see is a blank sheet. There's really nothing here. I'm going to start to, first and foremost, click on this browse button. And you can search for whatever item that you want to look for, but I'm going to click on browse so that way you can see what all is available. And I'm going to jump straight to, first and foremost, I'm going to just make a very basic market cap criteria. So I'm going to say, market cap has to be greater than, go over here, market cap has to be greater than, a minimum, $1 billion. So I'm going to select market cap right here, add metric, and I'm just going to say greater than or equal to 1,000. So that means 1 billion. It's a very basic, minimum criteria. And then I'm also going to give a price requirement too. So I'm just going to say no stock, all stocks greater than just $10 a share. I'm going to say that price current greater than or equal to 10. Okay, so you can see how easy it is to select and to specify a value that you're looking for. And you can select a number of different types of operators, like greater than or less than. You can even say does not equal to, or you can even search for, top 100 or top, 10%. So there's a lot of flexibility in terms of how you want to structure the screen. I'm just going to make it a very basic, one for now. So we're looking for all market cap stocks greater than $1 billion, and current price has to be greater than $10. Now let's look at where we can start to incorporate these quality characteristics. So if I go back to browse, and if I go under this quantitative scores section, we have here listed out two specific scores that I want to bring to your attention. One is the Piotrowski score. And Piotrowski is a professor, Joseph Piotrowski. He's a professor at the University of Chicago. And he came up with these signals, which are all derived from the balance sheet and cash flow statement, as well as a few items from the income statement. And if you look at what is going into the score, it'll look very, very similar to what we just saw in my presentation slide, which summarizes that paper from the Financial Analyst Journal. It takes a look at return on assets. It takes a look at return on asset growth. It looks at cash flow. It looks at cash flow relative to earnings. It looks at leverage. It looks at liquidity. So these are all factors that right now are becoming front and center because we're finding out, through this crisis that, which companies actually have the liquidity to survive this crisis, and which companies actually have quality balance sheets. So using Piotrowski score, we can help quickly identify who those companies are. And so if you look at that, basically the composite score right here is a score from 1 through 9. And all it does is simply say, adds up each one of these individual criteria up until it gets to, a full tally. So each of these are worth 1 point, and it can sum up to a total of 9 points. So if we screen on that aggregate Piotrowski score, if I hit add metric, and what we want to do now is really search for the top companies that are matching that. So we want to say greater than or equal to, let's just say 7. Okay, and you can be pretty flexible on that. You can say 6, you can say 8 to be even more strict. But I'm going to say 7, so that basically gives us the top 33 percentile because we're searching for the 7s, 8s, and 9s out of a total possible score of 9. So that gives us the upper third of all stocks. So if I click on add, we're going to go from, it was over 2,000 stocks, and now there's about 505 tickers. So this is what we're doing here is basically defining a universe from which to select from. So if I run the screen here, it's going to give us all 505 stocks, and this forms the basis of a broad investment universe that you can work with. So this could be, your starting point from which you add your additional factors that you normally look for, say price to earnings, price to free cash flow, EV to EBITDA, or any other metrics that you look at across the board, even dividend yields, for example, or dividend growth. This is, the sort of should be the backbone to, any investment strategy. I'm not saying necessarily the Piotrowski score should be, but quality factors in general should be the backbone of any investment strategy that you advise clients, put their assets in. So this is one approach. Now, if we go back to the list of scores here and go back to the quantitative scores, so we saw the Piotrowski score. It has a lot of profitability ratios. And going back to the PowerPoint deck, you can see that profitability is just one aspect. There's many different aspects of quality. There's also accounting quality, as well as investment, so CapEx, as well as things like earning stability, which is very, very key, and capital structure, like debt to equity, net debt to EBITDA, things like that. So going back to this, the Piotrowski score does leave out investment. It's not as big of a factor in this score. So if I go down, and this is the next score, the Mohanram score, and Professor Mohanram is a professor at Columbia University, and he came up with this score. It's actually very similar to the Piotrowski score. You can see that there's a lot of similarities here. There is an equal emphasis on return on assets. There's also an emphasis on, cash flow as well as earnings, but it also factors in earnings variability. So basically looking for companies that have very low volatility in earnings. That's also a measure of quality. And it also incorporates things like R&D and CapEx. So this also incorporates a little bit more of a growth tilt. So this will help identify companies that are not only showing strong quality in profitability, but also companies that have a tilt towards growth. So if I screen for this one, this is a scoring system from 0 through 8. So each of these items adds up to 8. So it's either a 1 or a 0. Return on assets has to be greater than 0. Cash flow return on assets have to be greater than 0, or at least, and in this case, it's actually comparing to the industry median as well. So that's another differentiator from the Piotrowski score. So if I screen by that, and if I add that metric, and this one is a ranking from 0 through 8, let's just screen for stocks that have a greater than a value of 6. So that gives us the upper three, the three highest, scores that are available, 6, 7, and 8. If I add that, now we're down from 505 tickers down to about 150. So if I click on Run Screen, this will give us a very, very narrowed list of stocks. And now you can see that a lot of these companies are are very identifiable. You've got a couple of insurers in here. You've got a couple of healthcare stocks in here. So a lot of companies certainly, that are presenting themselves like Church & Dwight that, have shown to be relatively, immune, no pun intended, to the crisis that we're in. Now we've got a couple of other stocks in here like Delta, which have gotten flatlined from this entire crisis. But you can see here that these are companies that have very, very stable and sturdy balance sheets. So whenever you're looking at, sitting down and talking to your clients who you're advising for, these companies right here, have the cash and have the profitability to be able to weather the storm. So this is something that you can take back with confidence and say that, look, these are companies that have very strong profitability and balance sheet ratios. So of course, the profitability is going to drop this year because, companies are simply not able to operate because none of us can actually step outside our houses for anything other than groceries and basic healthcare. But assuming a normalized economy, assuming that at some point we're going to be able to get back out and the economy will reopen, it's safe to say that these are the stocks that will lead that rebound on the aggregate, that is. Individual stocks, it does require a little bit more analysis, but you can see here, companies like PayPal, they're going to be pretty insulated from this. Companies that you can just see across the board, some of them are hit very hard Others are, fairly insulated from this, but overall, these are companies that do have, or at least have demonstrated, strong returns on capital, as well as strong or ample liquidity on the balance sheet. So this is one way to go about it. Now, the key difference here between the Piotrowski scores and the Monram scores versus simply coding your own values is that these scores are relative to its own history. If I go back into that and look at the description, the components of the Piotrowski score are basically that ROA has to be positive, so it just has to be greater than 0. And then ROA has to be greater this year than the previous year. So it's looking at the company versus its own history. Whereas if I were to start from, coding some of these items in myself or yourself, you can specify a little bit more than just looking at the company's own history. You can start to, define variables such that it looks for, companies that rank very high relative to other companies. So if I clear this screening criteria here, let me just remove these two. And let's say we want to go back to, say, for example, return on assets. If I go back to under the ratios section, here we have a nice variety of financial and valuation ratios. And here we can see ROA. So let's select ROA here, TTM, that's trailing 12 months. I'm going to add this metric. And now I'm going to say, instead of, a specific value, I'm going to say it has to be in the top 50 percentile. So we're going to look for the best, the upper half in terms of return on assets. And big picture item, why are we using return on assets? The short answer to that is because companies have differing capital structures. Some companies have a lot of debt. Some companies are debt-free. So return on assets normalizes all of that. So it looks at profitability relative to their total assets. And assets is universal across the board, because if a company has a lot of assets, it could be because they have lots of cash and low leverage, or it could be because they have lots of leverage. So using return on assets helps normalize companies across the board, regardless of their capital structure, and looks at whether the company is generating high profits relative to assets, regardless of if they have a lot of debt or not. So that's why return on assets is a very key component of any quality analysis. So we're going to say, again, ROA has to be in the upper 50 percentile. Now we're going to look for return on equity. So we want return on equity to be equally strong. So we're going to say ROE has to be also in the upper 50 percentile. So we're going to go from 1160 tickers so far, right? With these first three criteria, we have about 1160, companies passing. And now it's going to get cut in half again because I'm about to do upper 50 percentile by ROE. Now we're down to 580. Okay. And now we're going to go over to, similar items. Now we're going to look at the quick ratio. And the quick ratio, if you recall, is looking for companies that have a lot of cash on the balance sheet relative to their short-term liabilities. Because this is a big thing right now. We want to make sure that, especially right now, with the economy basically at standstill for the next month or maybe even 2 months, we really don't know yet. We want to make sure that we're avoiding companies that have the worst quick ratios, meaning they have very low cash relative to debt that's coming due in the next year. So we're going to go down here to the quick ratio, and we're going to add that metric. And what I'm going to do here is I'm not going to say top 50%. I'm going to say top 75%. So we're really just getting rid of the bottom quarter of companies in terms of their quick ratio. Okay. So now we're down to 435 stocks. So we just eliminated a quarter of the companies with the worst quick ratios. And finally, I'm going to add the accrual signal. So if you go back to the Piotrowski and Moenram scores, the accrual signal, if you recall, is looking at cash flow as opposed to earnings, because earnings can be, massaged, it can be manipulated, it can be, sometimes companies can, pass through a lot of accruals, which are recognizing revenue without actually collecting the cash that comes associated with it. So again, these are all measures of quality. How good is a company's reported earnings? So cash flow has to be greater than earnings. If it's not greater than earnings, then there's a risk that there's too much accruals and not enough cash generation. So I'm going to make sure that that number is equal to 1, because recall, all of these are basically a binary 0 or 1. Is cash flow greater than net income? Yes. If yes, then 1. If no, then 0. So we're going to add this metric, and we're just going to say equals 1. So therefore, we're just basically making sure that cash flow over the last year has been greater than earnings over the last year. So if I run that, and we see now we're down to 359 stocks. So again, this is a list of companies that you can go back and say, with very, very strong confidence that these are companies that are, the strongest return on asset generators, the strongest return on equity generators, and who have ample cash on the balance sheet to be able to weather, any economic downturn better than most other companies, and companies that have very strong cash flow as well as the associated free cash flow. So again, this is a list of stocks that you can go with confidence and say, these are, companies that will be able to outperform over the next, year, possibly even longer than a year. And you can see some very, very strong companies like Apple that are passing. A Biomed as well, I've been looking at that. Abbott Labs, Accenture, Adobe. So these are very, very high quality companies that are now passing, the screening criteria here. And so the way that I would view all of this is that this should be the basis or the foundation from which you can now do additional analysis. Like if you are a dividend investor, you can look for now the companies on this list that have the highest dividend yields, because we've already screened out the very lowest profitability and lowest liquidity companies. So now if I were to add to this, just to the report, let's just say we want to add a metric, and we're going to look for dividends, and I'm just going to add dividend yield to the report. So this is not screening, but we are just simply adding to our report, what the dividend yield, is. So again, you can continue to customize the overall report. If I run the screen again, it's going to now add that dividend yield criteria that we just, or the dividend yield item to the report. And you can see here what those dividend yields are, and we can click on that to sort by that specific value. These are the companies that have 0 dividends. Let me click that again to now show the companies with the highest dividend. So now, of course, there's going to be a few outliers. I probably wouldn't trust a 33% dividend yield, but, and again, it's this is an MLP, it looks like, so they've got issues right now, but overall, this could be a great way to generate ideas and to, assess whether, companies that have very, very strong balance sheets, associated with, high dividend yields at the same time, just as an example. So again, anyone that, is, advising clients, I'd highly recommend using these scores right here. And if you don't want to do, take all of these steps, the Piotrowski score or the Moenram score are very, very solid additions to your screening criteria as well. So I'd very highly recommend doing that as the basis of any investment strategy that you advise clients on. Now, once you're done with your screen, like let's say we want to stop right here, I would love to save the screen. That way I can refer back to it at any time. So I'm going to click on Save Screen right here. And this is telling me that it's actually been saved successfully, but that's because I had it saved prior to this call. It's going to, when you run this for the first time, it's going to give you an option to give it a name. So once you do that, you'll be able to save it. And next time when you come into this, you'll be able to click on Open Screen Library. And here are some predefined screens, but over here at the very bottom, under Saved Screens, you'll see your saved screen. So I just have it called Quality. If I run that, it's just going to reopen the same exact report as well as the screening criteria, and I'll be able to then, run that again. Now, there's also some very good integration with the overall Zacks Advisor Tools platform. You'll see up here at the very top, it says create/update watch list. Now, I have 359 tickers in here, so it's quite a big list. So if I click this, there is a limitation where it's only going to take the top 100, and it's just going to be sorted alphabetically. So I would recommend, trying to get a screening criteria that's less than 100. And then once you click on that, then it's going to show up on your home page under the quote monitor. That way you can constantly monitor that list of stocks. So as an example, I'm just going to add one additional criteria. Let's say you are a momentum investor. Let's say you want to just search for companies that are simply outperforming the S&P 500 using on top of these, quality characteristics. So if I go to Browse here, and I go under Price and Price Changes, and I'm going to scroll down here, and there is a section here called Price Momentum. And this is basically a relative strength ranking, and it basically groups all stocks from 1 through 99. 99 is the best and 1 is the worst. So what it does is it basically allows you to calculate whether companies are outperforming the S&P or not. Anything with a value greater than 50 means that they're outperforming. Less than 50 means they're underperforming for that corresponding period. So over the last 52 weeks, I'm going to add this metric, and I'm going to say it has to be greater than 50. So I'm going to look for stocks that have all of these very desirable quality characteristics and who are also outperforming the S&P 500. I'm going to run this screen right here and look at that. There's 266 stocks. So if you recall, just before we were at 360, I believe, or somewhere around that. All that did was eliminate 100 stocks. So even before this relative strength criteria, more than half or the vast majority of these quality stocks were already outperforming the S&P. So that in and of itself is, it tells you something about, how quality is what people are seeking, what investors should be seeking, especially in this environment right now, but really in all environments, whether it's a bull or bear market. But now we have, 52-week return has to be better than the S&P. So these are all outperforming the S&P over the past 1 year. And then I'm just going to add one last criteria. So let's just say you want to find the outperformers, but let's just say you want to find the ones that have really taken it on the chin over the past 12 weeks. They're still outperforming over the past 1 year, but they're underperforming in the most recent 12-week period. So just as an idea generator here. So let's just say less than 45. I'm just going to say 45. You can say less than 50. That's going to find all stocks that are underperforming. I'll just take it a little bit further and say under 45. And now we're down to 32. So these are companies now that have very strong quality characteristics, are outperforming the S&P over the past 52 weeks, but have really just taken it on the chin over the past 12 weeks. So these are companies that are very, very strong in terms of potential ideas, in terms of timeliness. Companies that are, having a correction right now, but are still beating the market over the past 1 year, including the most recent 12-week period. So if I were to save this screen right here, I'm going to save that. And now I'm going to click this Create Update Watch List. It's been updated successfully. So now if I go back to the quote monitor or just click on the Zacks Advisor Tools homepage or logo, the very first thing that you're going to see is that quality portfolio, and this is that list of 32 stocks that we just found here. So overall, there's a lot of flexibility, a lot of integration, very easy to use, screening. So again, if you don't want to go through these, a myriad of different options right here, again, we've really simplified the approach for quantifying and building in quality into any screen that you run, simply with the Piotrowski score, which in a nutshell, I would say measures pure profitability. And then the Mohanram score, which weights growth a little bit more than Piotrowski, but still has a strong presence in profitability. So again, these are two scores I'd highly recommend using as a part of your overall strategy. And you can then, take that back, to your clients and say that these are companies that have very strong balance sheets and that you can invest in with confidence, over the long term. And have pretty good assurance as to performance as well. So again, if you have any questions, I hope this was helpful. If you have any questions, I'd love to hear from you. Please do send an email to zat@zacks.com. Again, zat@zacks.com, and we'd love to get back to you on that, and hope to continue seeing you at future webinars just like this. And I hope we can continue adding value to your overall investment process. Thanks, everyone. Have a good one.